What's up, guys? Mike Sharp here. This is Sharp Investing, and I'm going to talk about Applovin here. And I want to apologize first off to people who normally watch my channel because I usually try and get videos out as soon as I buy something, and this one is extremely late, and this video might not be that helpful because I bought this back in January, late January, and the thing has just taken off since then. I've actually been trimming on the way up, so I've just got under 50% of the original position left. It has been an amazing performer. Like, it's up over 6 times since I bought it, and I'll put a screenshot up to show the original price I bought at, somewhere around 50 bucks. I think it was a little bit higher, but you know, what I'll do in this video is I'll go over the business and I will do some financial analysis and talk about what kind of moat I think they have, or are building potentially. I do think it's possibly a great long-term business, and I think the market's kind of waking up to that, and that's why we're seeing this the stock price rocket up. But I don't think the ship is completely sailed yet. This is going to be a cyclical business. They're a mobile ad network, which means that, you know, like in 2022, ad spending dried up to some extent, and their revenue growth and their profitability came down in that year. So I would expect that it's probably going to happen again at some point, and that these crazy multiples we're trading at now will contract. I don't know when that's going to be. We could, you know, if it's a 5-year expansion, they could grow into this current market cap of 113 billion. It could happen pretty quick if there's no economic headwinds in that time. So I don't really know what's going to happen. The position got too big, so I started trimming. I've taken off my original purchase price plus, basically I got a double that I've taken off the table, and I'm just going to let the rest ride. But you know, I do think it's a you know, if you have a long-term time frame, it's probably a good one to understand and maybe, you know, figure out what your valuation is, and if you get a fat pitch in the strike zone, you know, I'm definitely going to take another swing if the price comes down and the valuation becomes more reasonable. But like I said, mobile gaming ad network, basically they are on, well, they help game publishers buy and sell ads. So imagine you are creating a new mobile game and you want to get ads onto your game and get some revenue. Well, you'd use Applovin for that. And, you know, if you wanted to promote your game, you wanted to place ads somewhere, you'd use a different part of Applovin to place your ads. And so basically they're on both sides of the auction, both sides of the ad network, which means that they can get a huge amount of data, which is potentially where the moat is being built. Now I'll get to that in a minute, but just quickly on the overview of the business, they have about 1 billion daily users. Like I said, they're kind of like an auction house or a market maker for mobile ads. They are about 30. They said that they're 30% of the market, and they're taking market share right now. Their main competitor, Unity has stumbled a bit in the last few years, and that has been to Applovin's benefit. They say they're the third largest ad network behind Meta and Google, and that gaming, they're specifically involved in gaming right now, but that can change, right? So there's some upside there if they get into other areas, which they're already starting to do. If you listen to their earnings call, they've got into e-commerce, they've got a new product there, and they're just in the testing phase. Now, I don't expect that to explode because they're sort of organic growth business, which is interesting because they're an ad network, so they don't actually market, but they're an ad network. So it's interesting that way. But you know, they've gotten here through organic growth, which makes me think that that's entirely possible on the e-commerce side. But gaming is 60% of all app spend, so they're already in the majority of the market. So that's the meat and potatoes of this business, and it will be going forward. So just in terms of their main revenue stream, so Applovin Max is the is basically the auction house, and so they represent the selling side, represent the sellers, and then the ad networks will bid on those ads, and that's the buyer side. And so they have Applovin Discovery, which is on the buyer side. So like I said, they're on both sides of the equation. They don't always win the auctions on the other side because there's other big companies bidding on ads as well, but they do get a huge amount of data that way. So they do have, so that's the software side of the business. They're going to call it ads soon, or at the ad portion of the business. But if you're looking at their financials, that's what they call software. They also have one called the app side, which is previously they bought some game publishers, right? And so they did that so they could get the data from the gaming side to help build this other part of the business. And that part of the business is a very slow growth, maybe even flat, with not a huge profit margin. So that portion of the business, they're actively, I think they're talking about potentially selling it, and because that part of the business is no longer necessary for them, and it also somewhat distorts how good the business is, which leads into my original thesis back in January, which I didn't tell anyone because I didn't do a video. Again, my apologies. So if we go back to sort of how did they get here, one of the big changes in the industry was Apple. They stopped allowing basically they took the ad tracking and made changes to it so people could opt in or out of sharing their data, and obviously not everyone's going to share their data. So that the ad network side became a lot more opaque because you're bidding on ad spaces, but you don't have as much information, right? So originally, I think it was the idea is that definitely hurt a lot of businesses, but Applovin is actually one of the beneficiaries of that in the end, I think, because what happened was the data. Now nobody has the data except these auction houses, right? So Applovin Max is getting all the information from the seller side, and they're able to track the outputs on the actual how the ads perform and stuff like that. So they actually have this really valuable set of data that allows them to price the ads properly, and this is really valuable in the industry. Now, I am not sure that I 100% sure. No, I'm definitely sure I don't understand how the nuts and bolts of this work. But if you're interested in learning more, I would really recommend listening to, on Yet Another Value podcast, which is a great podcast. And there was an episode last May 2023, which is where I got the idea from. And Doug from Fabricated Knowledge, which is a great Substack if you're interested in anything semiconductors, he came on and he pitched this idea, and he obviously understands a lot of the nuts and bolts of the back end side of it. So if you're interested in this, I suggest listening to that one. I didn't understand it right away, but I thought, I should buy some of this because it sounds really good. It was trading at 10 times free cash flow at that time when I listened to it. I think it was trading at $20, and I just didn't do it. And what happened was in January, I was still learning about it, and it did this amazing trading pattern. So basically it was this sideways sort of box, which is the pattern that I really like in trading, and there was a breakout, and I thought, that's my chance to just buy this because that's a good entry spot for me. That's my trading pattern that I like to make entries on. So originally it was a trade, and once I bought it, then I had to research even more, and as I researched, I said, oh my God, this thing is phenomenal, right? So I've just kept it. So a little bit lucky for me actually that it did that pattern, or else I might not even be in the stock. Anyway, back to the data side of the business. Now, if you another recommendation is read Hayden Capital's letters. They do own this position, and one of the quotes I will say is, "Scale is especially important in this opaque industry since the clearing price isn't shared among parties. By seeing the entire transaction and more transactions, Applovin has far greater insight into where real-time prices are." So this is the potential moat, right? And so if we look at data moats, think about Google, right? The more data that you have, the better your outputs, the better your algos work, and the more customers you get because you have the better data, because you have the better outputs, and it's sort of a self-reinforcing feedback loop where if you get to a certain scale, you basically you have a moat so wide that nobody can possibly collect the data they need to compete with you properly, right? So that is the potential long-term outcome here. Now they're around 30% of the segment right now. We have to keep an eye on that. If they get to become even bigger, like more than half, this flywheel could push a lot of the competitors out long term. Now, I'm not sure about that. Take that with a grain of salt. But that's what I see as, why this could be like a 10-year hold type situation. They also have they also have an AI machine learning platform called Axon, and they have just released Axon 2 years ago, which is an upgrade on their previous incarnation of Axon. And you can see since they released that, their revenues have really gone through the roof, right? So they're using this is an AI play, but it's not like NVIDIA where you're creating the picks and shovels. They're using AI to squash the competition and grow enormously, right? So you can really see, and this is the juice behind that feedback loop, or the feedback loop. Yeah, that's negative, right? What is it? A network effect kind of thing, data moat. This is the juice behind it, because as they crunch the data, bigger piles of data, their algos get better and better, and basically they can potentially run away with the thing. I guess I should also explain a little bit. I probably should have done this at the beginning, but another way to understand what they do is, let's say you're playing a mobile game like Wordle or something. These casual games, hyper casual, I think they're called. And every time, if you're playing for free, you finish your puzzle and then you have to watch an ad, right? And you have to watch it for 30 seconds. And sometimes you can even play the ad, like it'll do a little you play, or sometimes there's just a banner for an ad at the bottom. And so that's Applovin, in action, right? That's them placing those ads for their customers, or selling those slots, right? So yeah, I mean, that just helped me understand it when I thought of it that way. So if we look at the financial side, like just a quick overview, and then I'll get into the financial statements afterwards. But basically, this business, if you just look at the financials, they look really good, right? So if you take out the app side and just look at the software side, you can really see the massive growth. But if you look at it, even as a whole, you can see over the last year, there's massive operating leverage. That's going to continue going forward. And, there's huge growth. And if you combine those two things, you get a real explosion in net income, right? So the revenue growth is about 45%. I'm just eyeballing it here year over year. I forgot the actual number, but let's say 45%. But their incremental margins are right around 100%, right? So basically that 45% of revenue, it cost them nothing to add that revenue, nothing, right? So if you combine those two things, zero cost associated to that 45% revenue gain, you have a 400% increase in net income, right? And their EBITDA margin on the software side is 75% right now, and that is going up. Like I said, because there's no cost attached to it, right? They have their developers are the cost, but and they're working on the Axon 2 platform, maybe towards an Axon 3 platform eventually. But the costs are all covered. They have almost no capex, and so you can see the financial explosion has shown up now, and the market's really noticing this. So if we go back to my original thesis was that, I did see that remember, this is before they released the Q4 results last year. But you could see it on their financial statements, right? You have these apps, this slow growth, low margin business, and then you had the software business, which was smaller at that time. And if you added them together, the business looked okay. The growth didn't look great. The margins were pretty good, but nothing to. So my idea was that as this software business got bigger, the true value of this business would start shining through, right? You'd see these massive margins, and even if the actual revenue wasn't accelerating, it would look like an acceleration in terms of net income, and that's exactly what's happening now. Just because we got to a point where the apps business has been dwarfed and is no longer sort of like impacting the overall results in a major way, right? So that was sort of the general idea. Now the company did grow quite a lot, right? But you're really seeing the software segment of the business grow now. In terms of growth, the company grew 1.5 billion in revenue in 2020, and what was it? Software was about 200 million, and so but now they're at 4.4 billion, sort of on track for that 2024, and the software is going to be at 3.1 billion, right? So the company grew 3x, but the software was this small thing, but it grew 15x in that time, right? So it's starting to look really good. Now, if you project forward, if you listen to Adam, the CEO, he's projecting long-term growth of 20 to 30% still from here. And, and how does he get there, right? You got 3 to 4% industry growth just in the segment alone, right? So if they just grow at the size that the segment grows, you're going to get that 20% growth. You're going to hit the, close to the bottom end of that growth target. But then on top of that, what happens is this Axon 2 AI engine, it adds another layer of growth on top of that. And it's really important to understand why this works, right? This is an elastic situation in terms of demand as compared to the ROI that Applovin provides to its customers, right? So if you're advertising on Applovin, let's go back to the example where you've built a game and you're advertising on it. If you can see that your revenue targets are being hit and you're doing really well, every dollar you, like for example, let's say, well, actually they let you plug in their platform, I forget the name of the platform, they let you plug in your revenue goals, your ROI goals, and they say, okay, let's say I want to make 100% of my revenue back in 2 weeks, right? 100% of my ad spend in 2 weeks, and then you place your ads and they can see how they do versus those targets, right? So let's say you're plugging in your revenue targets and you hit them, maybe exceed them. What are you going to do? You're going to say, okay, well, that was a good investment. I'm going to invest more, right? Because I know I'm going to get my money back. I know I'm going to make money on these ads. I'm going to spend up to the point where they're not making me any money. So what happens is the Axon 2 engine, it improves the ROI on those ads, and so the advertisers, the companies looking for advertising, they're seeing their ROI go up. So what do? They just spend more. It's like if I say, for every dollar you give me, I'm going to give you $2. How many dollars are you going to give me? Like all of them. You're going to give me all of them until that deal stops being true, right? So they're not. I think Adam talks about this. The CEO, he says their growth is not externally dependent, it's internally dependent, right? So if they can keep creating these improvements in their engines and keep improving the ROI for their customers, the customers will just spend more. And so the whole game here is get the data, improve the algos, improve the ROI for your customer spends more. And basically your job is to just improve the Axon software in the background. So that's just generally a quick overview of how it works. But if we look at the financials, I'll just go through a few slides here from the letter. They also said they're not going to provide shareholder letters quarterly now, so they're only going to do it each year. And they said, well, companies are built in quarters. I like this line. It said companies are built in quarters, or companies are built in years, not in quarters. So we're going to stop focusing on quarterly results. We're going to focus on annual results. So that shows to me that they're long-term thinking. This is not about appeasing shareholders for the next 9 months. It's about, let's build the best business we can. And, you know, the CEO Adam, he's been very consistent with that stuff, listens to a lot of the calls. So this guy's a long-term, big picture thinker, which I like being aligned with when I'm investing for the long term. All right, if we look at the numbers here quickly, revenue is up 39% year over year. I said 45%, so it's actually 39%. So not huge growth, but you'll see that the underlying numbers have grown pretty fast. The bottom line numbers. So software is up 66%, and EBITDA margin is now at 78% on the software side. So that's massive, right? Like I said, it's almost all profit now, and you know, that's still going up because there's very little cost, if any cost, to grow. If you look at the net income, up to the EBITDA margin is 36% overall, and again, that's being dragged down by the app side, but still starting to look really good. Even that number is tripled year over year. So that's back to the thesis. The big numbers are starting to show up now. The stock's reacting. So if we look at these cash flow from operations, actually I should talk about EBITDA first. Most companies, this is kind of a bad number to look at, and Charlie calls it bullshit earnings. But in their case, it's pretty close to legitimate cash flow and net income, because there's very little capex, so you don't really need to do any depreciation. Amortization can be from old acquisitions and things like that. They do have interest, which is a legit expense because there's over $3 billion in debt. So that's a legit expense. But in terms of looking at, let's say, quarter over quarter, year over year numbers, EBITDA is a pretty good number to look at. And that debt pile, like, they could really just pay that off pretty quickly now. It's no longer an issue the way it may have been in the past. You know, they can issue some more shares or just stop buying back their stock and pay it off. Yeah, like I said, if you look at the cost and expenses part of the business, you've got cost of revenue is up only $4 million in the 3 months for quarter three, and total cost and expenses is actually down $14 million, right? So it actually saved $14 million while growing the revenue by $330 million, and that's why you've seen the explosion in earnings. There's the interest expense I talked about $300 million for the year, and $75 million a quarter. Net income per share up to $1.25. That's 4x from last year. There's your massive growth that the market likes. And if 9 months year to date, it's up almost sixfold. So now this will come down. This growth rate will come down, and the market probably won't like it, and the multiples will contract a bit, maybe, you know. But I'll do a DCF in a second here. If you look at the cash flow, well, balance sheet, I don't think we need to talk about the balance sheet. Basically, they just take excess cash and buy back shares right now. There's 3.5 billion in debt and about 3 billion in net debt. So, but given the market cap and given the cash flows, that's almost irrelevant at this point. So I'm going to skip over to the cash flow statement. The one thing I would look at here in the cash flow statement is the stock-based comp, $275 million for the year to date, and that's a pretty big chunk of the operating cash flow. Operating cash flow 1.4 billion, and so you'd see they're on pace to get, I don't know, what's that, another 5, 6? I don't actually don't know off the top of my head what it is per quarter, but let's say they're going to be at 1.9 for the year. But I think you do have to take off the stock-based comp, because that's a real expense, and it's bypassing the income statement because they're just issuing stock-based comp and then buying the shares back here, both which, you know, don't land on the income statement. So we have to put that amount back. So 1.4 billion for the 9 months year to date minus 275 million. You got 1.125 billion in operating cash flow, and like I said, very negligible capex at this point, right? They don't need to spend anything on that. So good looking financial statements. They're improving really fast, and you can see why the market is happy about that. If we look at the let's see if I can pull up my DCF here. The DCF, what I've done is I've done two. One is assuming a 20% growth rate for the next 10 years with a discount rate of 15% and terminal multiple of 10 times EBITDA. And the reason I'm doing this DCF, I don't usually like DCFs because I think they give you a false sense of security, and because you can't really project this stuff 10 years into the future. But the reason I'm doing it is because the growth rate is so fast in this business. I think it's really hard to figure it out with other, like, to get a ballpark idea of like what the business is worth. So I think for me, this is at least gives me a range, right? So if we do this 20% growth rate, 15% discount rate, and what I'm doing is I'm saying the software EBITDA margin going forward is 78%, and all the growth is coming from the software segment. It's not coming from the app side. Now, EBITDA margin could be higher than that, but let's say 78. If we did all that, basically it's trading at fair value right now, which is surprising. When I did this, I was like, oh, actually, that's really interesting that it's sort of 114 million fair value. That's a pretty high discount rate too, at 15%, but also the growth rate's really high. If you look at the price to EBITDA, it's about 43 for 2024, which is actually not as bad as I thought it was going to be. I might have that doesn't sound right to me, but anyway, on this sheet, that's what it says. The second one I've done is, let's say you get 30% growth for 5 years, then it goes to 20%. After that, the rest of the assumptions are the same. Discount rate 15%. DCF says that this company would be worth 172 billion right now, which is a 34% discount. The market cap, the current market cap's a 34% discount. So, you know, maybe it's undervalued. I don't know. I guess it depends on what the future growth rate is, which I don't have any qualifications to figure out myself. So take all of this with a grain of salt. This isn't investing advice. I should have said that at the beginning. This is just me and how I'm thinking about this business that I own. But, you know, I do think that, I should talk about risks. Yeah, risks. So where's my risk list? The obvious risk here is the stock price. The stock price is really high, and it has a lot of future growth baked into it. So if you ever see a slowdown in the growth, the stock's going to probably get hammered, right? And growth always slows down eventually. I just don't know when. It could, if this keeps up for 3 years, the fair value of the business could be quite a lot higher. It could be double where it is right now, even though it's elevated right now. So I don't know. It's a tough one to play. I've taken stuff off the table. Oh, and sorry. Last one is the other obvious risk is that it's cyclical. It's advertising, and if the economy slows down where they are, usually in the United States, then that's going to hit advertising spend, right? Because that's one of the first things that companies cut when their P&L starts looking weak. They cut advertising, they cut staff. So it will be cyclical. I think there's going to be another pitch to hit at some point, and I'm going to wait for it. Anyway, hope you got something from that. Again, my apologies for being 11 months late with this, but hope you have a great day, and I'll see you in the next video.